Welcome to the deep dive. Today we're really getting into the details of Aadhar Housing Finance Ltd. We're looking at their financial reports for the quarter ending June 30th, 2025. Our mission, like always, is to unpack all this information, find the key insights, and figure out what it all means, for the company and maybe the wider market too.
Exactly. And we've gone through the official stuff, their stock exchange filings, press releases, the investor presentations. So we're aiming for a really thorough look here.
Okay, let's start with the basics then. To really get a handle on Aadhar, what's their core identity? What are they fundamentally about? Well, Aadhar Housing Finance, they're really zeroed in on affordable housing, specifically for what they call the economically weaker section, EWS, and the low-income group, or LHR Ridge. And their focus is mainly on semi-urban and rural India. They even have this motto, right? Jamat Chihar Banega to Desh Banega.
Yes, if homes are built, the nation will be built. And that focus is really important strategically. It's a huge market segment, often quite underserved. Their whole business model is built around this. You see it reflected in their average loan size, which is around 10 lakh rupees.
10 lakhs, right. That definitely tells you who their target customer is.
Precisely. It's not about high-end properties. It's about enabling basic home ownership for a really vital part of the population.
So how did this model actually perform in the latest quarter? Let's look at the headline numbers for Q1 FY26. We're comparing year over year with Q1 FY25. Assets under management, AUM, that grew by 22%. Pretty solid. It's up to Rs, 26,524 crore now.
22% is definitely solid growth in this space.
And disbursements, the actual loans given out, they jumped 32% to Rs, 1,979 crore.
Wow, 32% increase there? That's quite strong. Shows real demand, doesn't it?
It does. Profit after tax, PAT, also up by 19%, reaching Rs, 237 crore. And their net worth is Rs, 6,616 crore. That's a 17% increase. Though we should note that includes the proceeds from their IPO, right?
Correct. The IPO funds boost that net worth figure.
Yeah.
Still, healthy growth across the board.
They also mentioned hitting over 306,000 total loan accounts. That's a lot of families.
It really is. And these growth rates, they signal Aadhar's ability to effectively scale up in this affordable housing niche. It's one thing to serve the market, another to grow like this within it. Just to add, the earnings per share, the EPS for the quarter came in at Rs 5.50 standalone and Rs 5.37 consolidated. So decent earnings alongside that expansion.
Okay, those top-line figures look good, but sometimes the deeper story is in the financial health ratios, isn't it? Profitability, asset quality. What do those tell us? Their return on assets, ROA, for Q1 FY26 was 4.0%. Now, that's actually down slightly by 6 basis points compared to last year, just 0.06%.
Very slight dip, yes.
And return on equity, ROE, that was 14.7%, also down a bit more, 120 basis points year over year.
Right, a bit more noticeable there on the ROE front.
Then asset quality, gross non-performing assets, GNPA, on their AUM, that ticked up slightly too, by 3 basis points to 1.34%. Net NPAs, NNPA, stood at 0.94% standalone, and their provision coverage ratio, PCR, was 32.44%, also standalone.
Okay, so looking at those shifts, the small decrease in ROA and ROE, and the tiny rise in GNPA, you really have to see it against the backdrop of that rapid growth we just talked about. Growing AUM over 20%, disbursements over 30%, it's not unusual to see a little pressure on profitability ratios or a slight uptick in NPAs as the loan book seasons. It doesn't immediately scream problem.
So potentially just the cost of growing so fast.
Potentially, yes, or just the natural maturing of loans originated during that expansion. What's quite reassuring, I think, is that provision coverage ratio of over 32%. It shows they are setting aside a decent chunk of money against potential future losses. It suggests, prudent risk management even while they're expanding quickly.
That makes sense. So strong growth, slight pressures on some ratios, but seemingly well managed. The big question then is how? How does Aadhar actually fund all this growth and reach so many customers, especially in rural and semi-urban areas?
Well, their funding strategy is quite diversified.
Yeah.
They have relationships with 43 different lenders. That's a good spread. Means they're not too reliant on any single source of funds.
43, wow. Yeah. That's stability.
It is. And significantly, their long-term bank loans and NCDs recently got a rating upgrade from CARE A to CARE A plus A with a stable outlook.
Ah, that's a big vote of confidence from the rating agency.
Absolutely. It reflects their financial strength. And look at their capital position. Capital adequacy ratio, CRAR, is at a very strong 44.61%, way above requirements. Plus, their liquidity coverage ratio, LCR, averaged over 354% in the last 90 days. Again, that signals huge financial resilience. Lots of buffer.
Okay, so they're well-funded, well-capitalized, but how do they actually reach the customers? This is where it gets really interesting for me. Their network, it's huge. 591 branches across 22 states in union territories, covering 547 districts. That's massive reach.
It is, but it's not just the scale, it's the type of reach.
Right, they have these deep impact branches. Tell us about those.
Yeah, these are set up specifically in more remote Tier 4 and Tier 5 towns, places often overlooked by traditional banks or bigger HFCs.
Smaller towns, basically, less developed areas.
Exactly. And they go even further with their Aadhar Mitras. These are local partners, could be, a vegetable vendor, a cement dealer, people embedded in the community.
So they're using local networks to extend their reach even further. Very clever.
It's incredibly clever. It gives them reach and local knowledge, helps build trust, and likely keeps operational costs lower than setting up full branches everywhere. It creates a real competitive advantage in these areas. And this physical reach is backed by a pretty thorough credit process. Centralized processing for salaried folks, but crucially, on-ground checks for income, business viability, plus proper technical and legal checks on the properties.
So a mix of local presence and centralized control. Seems robust.
It appears to be. It helps manage risk across a very diverse and spread out customer base.
Now, her story isn't just about loans and branches. There's the IPO last year, May 2024. How did that fit into the picture? They raised Rs 1,000 crore from the fresh issue of shares. Big chunk of that, Rs 75,000 lakh, was earmarked for future lending, right? To keep the growth engine fueled.
Precisely. That capital injection was vital for supporting the kind of AUM and disbursement growth we've seen. It provides the firepower for continued expansion.
And the rest, about Rs 20,000 lakh, was for general corporate purposes. They also made a point of saying there was no deviation in how they used the IPO money or funds from NCDs.
Yeah, sticking to the plan. It signals good discipline and transparency, which investors like to see. It's all about fueling that core lending activity.
And alongside the capital, there's this big push on technology, their digital-first operating model. What does that involve? Well, they run on a core system from TCS. They partner with over 40 fintech companies, and they're seeing results. Like a 35-minute door-to-login time. That's fast for a loan application start.
Very fast, especially considering their target segment and locations.
And a 97% ACH conversion for collections. That means almost all repayments are automated. That's huge for efficiency and reducing default risk, I imagine.
Absolutely. Smooth, automated collections are critical, reduces operational overhead, and improves cash flow predictability.
They also mention 100% paperless onboarding, over 129,000 customer app logins. They seem to be really using data science, AI, machine learning too, for credit risk, collections, even deciding where to open branches and setting interest rates.
Look, this tech investment is crucial. It's not just about cutting costs, though it does that. It allows for better risk assessment, faster processing, and a much better customer experience. In today's market, especially reaching underserved populations, leveraging tech like this is a massive advantage. It helps them scale efficiently and manage risk better than relying purely on manual processes.
And wrapping up the company picture, there's a strong social element too, isn't there? It seems baked into their model. Like 66% of their total loans, their gross AUM, is specifically with those EWS elite customers we talked about.
Yes, that's a huge proportion. It underscores their commitment to that affordable housing mission.
They also run CSR programs, Aadhar Kaushal for skills, Aadhar Angan for nutrition and education, Ayushman Aadhar for healthcare.
Right. Beyond just the lending, they're investing in the communities they serve.
And it's worth noting, their promoter is Blackstone, a major global investment firm. And they emphasize strong governance, independent directors on the board.
That combination is quite interesting. A clear social mission focused on affordable housing, backed by sophisticated private equity and seemingly strong governance structures. It's a model that aims to blend profit with purpose effectively.
Okay, so we've dug into Aadhar itself. Now let's zoom out. What's the bigger picture? What does this all mean in the context of the Indian market? And maybe for you, our listener, trying to understand these trends.
Well, the opportunity in affordable housing finance in India is just vast. Projections point to a need for something like 31 million new housing units by 2030.
31 billion units.
Yes, valued at around INR 67 trillion. And the financing needed for that, potentially INR 45 trillion. It's a huge underlying demand. And this is driven by some powerful trends. Rapid urbanization, incomes generally rising, smaller family units, all pushing demand for housing, especially at the affordable end.
And the government plays a big role here too, doesn't it? We hear a lot about increased budgets for schemes like PMAY, Pradhan Mantri Awas Yojana, plus ongoing things like interest subsidies, tax breaks for home buyers.
Exactly. Government policy has been very supportive of this sector. It creates a favorable environment for companies focused on affordable housing. And then there's the recent macro development. The RBI cut the repo rate again in June 2025. Third cut in a row, down 50 basis points to 5.50%.
Right. Lower interest rates generally make loans cheaper.
Precisely. It enhances affordability, particularly for first-time buyers and lower-income groups, especially timely heading into the festival season when buying sentiment often picks up. So you have strong underlying demand, supportive government policies, and now potentially lower borrowing costs filtering through. It's a pretty positive backdrop for companies like Aadhar.
It really makes you think, doesn't it? How do these companies like Aadhar keep balancing these two things, driving serious financial growth while also fulfilling this really crucial social need for housing, especially in an economy like India's it's changing so fast, with government help and all this new technology playing a role? It's a fascinating dynamic to watch, this intersection of business, social impact, policy, and tech, something definitely worth keeping an eye on.